Ladies and gentlemen, we are live and talking a little bit about Amazon stock. So I just got off the phone, and one of the things I was talking about in that phone call was Amazon stock and how low the profits actually are for a company like Amazon that's literally everywhere. And people must think, hey, this company, they're huge. They're a $1 trillion market cap. They do $500 billion in revenue. They must really be raking it in, right? Well, not so fast. We've got profits in the neighborhood, bottom line, in the negatives, okay? We've got profit margin negative 0.5%. Now, previously, they have had low to mid single-digit profit margins in previous years. For a minute, it looked like that was kind of sustainable. And then we hit 7% in, I believe this is 2021. And then we went and backslid all the way down to negative in 2022. We've got operating margins as low as 2.38%. Negative free cash flow per share. Negative EPS per share. And even when they're turning over positive EPS, the multiple has just been a little bit high, in my personal opinion. But honestly, one of the things I want to do in a little bit is look at a discounted free cash flow model of this and see, is there the potential that this is a fairly valued stock today? Is it one where maybe I just don't see it because I don't understand? Or is it just a case of Amazon has gotten a bit big for their own bridges? Now, we're pretty far off from recent highs, right? We've seen prices much, much higher than today by around 50%. But that, my friends, doesn't necessarily mean anything. If they were worth $20 and they went from 200 down to 120, well, that doesn't mean a whole heck of a lot, does it? So let's take a quick peek here at the discounted free cash flow. So first things first, we can't use a starting free cash flow of a negative number. Won't work for the model. So I'm going to look again at what they've been producing the last few years and see if we can kind of split the difference and put in some kind of normalized free cash flow. Okay. So yeah, negative numbers seem a bit on the low side. Amazon can produce more. $3 seems a bit on the high side. Honestly, I kind of want to split the difference between all of this and maybe have a starting point of $2 a year in free cash flow per share. Curious what this will spit out. I haven't actually run anything on Amazon recently. Woof. Okay. So if they were to start at $2 per share in free cash flow and grow it at 5% a year, which is, it's too low. That is too low. I will grant you that. Yeah, we would have a really bad fair value today. So I guess I'm curious what is a reasonable amount for them to grow this free cash flow. All right, let's say they get back to $2 free cash flow per share, which they have shown they can do in the past. What would be a consistent growth rate average over the next 10 years? All things being equal, 15%? That might be a little low, because even the $2 number, maybe it's a little low if they improve their margins, etc. Let's give them, we can give them a lot of credit and say maybe 25%, and then maybe say over the next 10 years it slows down and becomes an average of like maybe 7%. And this is just like literally top of my head type numbers. But this is something where even though like 25% is a lot of growth average over the next 10 years, I see that as being potentially possible. Maybe they can grow AWS, etc. And then, you add in the tangible book value for them. And okay, suddenly we're pretty darn close to the current price. And it does sort of make sense to me for how we would get there. But honestly, 25% growth is pretty darn good. A lot has to go right for that to happen, okay? So if we're going to assume really good things for the next 10 years, I think we need to build in a higher desired rate of return, higher discount rate, because, well, we're taking on a risk of that not happening or it being less than this. And so if this happens, we should require there to be basically a margin of safety to where we can still get a good return if we don't quite do that well on the growth. Now, applying a 12.5% discount rate, suddenly we get a fair value in the 94 range. Now, previously when I've run Amazon, I've come up with something closer to maybe, I think, around 80, and I think I watch listed it at 75 at one point. So the assumptions I made at that point must have been different than this, right? But the fact of the matter is that if I came up with something in that like 75 or 80 range, and today I'm coming up with 94, it's not like wildly different, right? I didn't come up with, say, $25 one time and then $200 the next, right? It's all really in kind of like the same relative like range. They're not varying to like an extremely wild degree, and it's probable that some of the numbers I'm looking at to come up with these assumptions are maybe a little different than what they were last time I took a look at Amazon, because maybe there's been a couple other quarters of financials coming through, right? And maybe we're thinking about things like changes in some of their business. Maybe their margins have gone down and we think they're going to go up. Maybe AWS is going in a different direction. Maybe Amazon is going to do something with pharmacy. Who knows? There's a lot of different possibilities at play. But we have to, if we're trying to come up with a value, a price to pay today, we have to take what they've demonstrated they can do and apply a realistic set of assumptions to it and try to come up with a price that makes sense for us to pay based on those assumptions. And the lower price that you pay, the higher your potential return. Okay? So this number, honestly, one thing I would probably look at in order to dial in this number a little more is maybe see what analysts think the EPS or cash flow growth per share might be over the next few years, and maybe adjust this assumption accordingly. Okay, this was kind of just my like off the cuff assumption of what I think might be a realistic amount, and this starting point is just what I think they could get back to in the next year or so, if they stop being in the negative. What I think a reasonable starting point is for their free cash flow. Right now, like, they've actually posted up negative, so like this whole thing could be completely off base if they don't recover back to this level of free cash flow in a relatively short amount of time. So it's super, super important to make sure that you realize that the price you pay is entirely based on assumptions for the future. And if you're not, disciplined and conservative in those assumptions, you will very frequently end up overpaying for things. And, if you paint too rosy of a picture, you're going to hurt your return by buying overpriced stocks. You don't want to do that. It's not what I want for you. So, with all of that being said, I don't really have a whole lot more to say about what I think a price to pay is for Amazon. Though, I am curious where the money is. Now, if we want to laugh, we can click on this Motley Fool article. So, had some hiccups in recent years. Yeah, that's like negative profit margin. That's a hiccup. So, it's just so funny the way they frame things sometimes in these articles. But okay, bear case, slowing growth for Amazon Web Services. So yeah, that is a good point. Actually, AWS is one of the higher margin parts of Amazon's business. So, oh, why hello there, Zocold. How are you? So AWS is one of the higher margin portions of the business. So if they can, the more they can grow that, the better for the actual bottom line. Because on their actual like retail business, they don't really make much. I mean, thanks, buddy. I appreciate that. What time is it where you are? So, if AWS is slowing, that could be, a challenge for Amazon in terms of growing their future free cash flow and earnings per share. Now, yeah, the bull case, recovering e-commerce business. The problem is, if your bull case is based on a recovering e-commerce business, that's great, and that it'll make revenue go up, but they don't really make that much. Like, the fact of like how convenient they've made it to shop without charging you all that much to do so means that they operate on like razor thin margins on the e-commerce side. And I believe there is a certain wisdom in getting you into their ecosystem. Sort of. Oh, hey, I'm in Arizona, so right now we're on the same time. So yeah, I don't know if I would really base a bull case on a boom in their e-commerce business. And speaking of Walmart, by the way, which gets brought up here, Walmart has bottom line margins of about 2%. So like retail in general, and that's on their brick and mortar and e-commerce combined. Like Walmart's just overall bottom line margin is 2%. So the narrative that you sometimes hear about like how these companies, they're just so greedy and they're price gouging people and exploiting their workers and yada yada. Well, here's the thing. They employ a huge amount of people, like millions of people, right? And they make these teensy tiny little profits compared to the amount of the revenue they bring in, right? And so like if you were to give everybody that works for them like a 10% pay bump or something, all of their profits would evaporate and they would be in the red. Okay? So, and that applies to both Amazon and Walmart, by the way. So, like the narrative of how they need to pay people a bunch more and stuff. Well, the only way they can accomplish that is if they raise the price to the to the shoppers and to the users, right? And who wants to pay more? Like, do you want the person either at Amazon or at the cashier station or whatever to make more money if it means that you have to tolerate like ever higher and higher prices for the stuff that you're buying every day? Well, that's going to be a controversial topic, right? But the average person would say, heck no, right? Nobody wants to pay more. Like the same thing comes up when you have like referendums locally on people's property taxes. Property taxes generally go to fund schools. And these people, their kids go to the schools, but like raising more money for the schools at the expense of having to pay a higher property tax, most people in a lot of areas will vote no, even though it's like, potentially like for a good altruistic thing of, better funding for schools. They don't want to pay more. People just inherently are averse to, shelling out more if they're not getting more for the money, right? And they can't like directly see the correlation. So, yeah. So that really doesn't, honestly, neither Walmart nor Amazon is really in a position to like be paying, their average frontline workers like all that much more money and like still be profitable. They both have like the most razor thin margins. Now, if Amazon was mostly like on like the software side, mostly like AWS and that kind of thing, if they were more similar to like a Microsoft, I mean, there's a reason people that work in tech make a ridiculous amount of money. Their margins are ridiculous, right? So why can they afford to pay? Why can tech companies pay so much better than retail companies? Well, we're looking at operating margins of like 2% here versus what's Microsoft? Boop, boop, boop. %42 versus 2%. 20 times the operating margin. This is why guys who go to work in software make a boatload of money, and why people who work in, retail oriented businesses like Walmart and Amazon as like frontline workers don't make nearly as much. At Microsoft, almost everybody makes a lot more than somebody that works any kind of like retail type thing. And most of them do have, the technology credentials and stuff to justify it, I'm sure. But I would assume even like the people in like their accounting department, et cetera, are probably pretty well compensated. Because, hey, like, they've got the margins to do it. And it's just, some businesses will be more lucrative for the people that work in them than others, right? Like, get the skill set to go work at Microsoft if you want to make six figures, Just saying. Everybody always frames it as like, oh, the companies are just, they're just greedy and that's the end of it. Well, all right, corporations they're sort of obligated to be greedy because their primary purpose is to return value to us as shareholders, right? So, yeah, they're greedy to an extent, but, the narrative that it's like outright exploitation and such, and that they have all this profit that they could just, pay everybody a lot more and just, this and that. It's really, they don't really have the room, to be honest. If they want to remain profitable at all, that is, right? That 2% doesn't go very far when it's split like between 1 million frontline employees, right? That's all I'm saying. So be skeptical of the narrative you hear sometimes about how bad these businesses are. I mean, granted, yeah, they all do some. I mean, every company this big has some skeletons in its closet. I covered that in a previous video, but like, it's really shades of gray and not just, business is bad, give more money. If the world was that simple, everybody could be in the top 1%, but that's just not how it works. So that's where I'm at with that. So, Zocold, you got any special requests for me, buddy? If you're still with us. This is a lot later than what I would usually do for a live stream, but I got preoccupied. Okay. What do you got for me, buddy? You're high on Baba. So, what do you mean by that? Like, did you pay too much for it? Is that what you're saying? Yeah. So do you mean you made a lot of money, or do you think you paid too much for the stock? So, here's the thing. Okay. All right. Let's see here. I've got a few minutes, so I'll talk a little bit more about Baba actually right now. So, I actually don't necessarily think that you did that bad at 130, okay? So, here's the thing. All right. I don't give credit for the tangible book on Baba. And I don't give credit for 20% growth, right? I think I did 9% in my video before, and I think I put in a 15% discount rate. So just so that we're 100% clear, all right? According to the assumptions I'm putting in here, okay, we would be getting a 15% annualized return, which is 50% better than the S&P 500's average over the last 40 years. So doing 50% better than the market return if we paid 121 or less. Okay? All we have to do is adjust our desired return, aka our discount rate, by 1%, and we're at your 130. So basically, if you paid 130 today with a 9% assumed growth rate of their free cash flow over the next 10 years, which I think is actually really super conservative, you could expect a 14% return on your Baba stock, right? So you probably actually did just fine, to be perfectly honest with you. I just used the rounder number just for like kind of illustrative purposes of, hey, like even if you paid as high as 121 at today's price, like look at the difference. Like if you buy it today, you're at a 24% discount for what you would need to pay to get a 15% return, right? It's ridiculous. And remember, this 9% growth rate is super stupid conservative, I think, right? Like, all right, little thought exercise. What do you think a reasonable cash flow growth rate is for Alibaba over the next 10 years with how fast the Chinese economy is growing, how fast their per capita GDP is growing, how fast their middle class is growing, and their disposable income is growing? Like, what number do you think would be actually reasonable? 20. I mean, here's the deal, man. To get a 15% return over the life of the investment, you could pay as high as 240 if you think that the cash flow will grow at 20%. And granted, we're also assuming it drops right down to 4% in the following 10 years, right? In that, right? I mean, is it really going to go from 20 straight down to 4? Probably not. Like, and granted, like it might be that it's like 40% some years, 15% others, and then maybe slowly, tapers down towards the end of the 10 years to like, 8-9%. And then maybe over the next drifts down to like 7, 6, 5, something like that, right? But it also won't be a straight line. There will be some that are like wildly higher than, the number you put in here. And there will be some that are way off target or even maybe like negative from the previous year. Right? Like you follow these like really ridiculous highs in the chip market, right? So Intel had, ridiculous revenue and then it fell because there were these ridiculous all-time highs during the pandemic. And you can see the same thing in almost any business. Like you'll have some years where it just randomly kills it, and then it might drop off the next year. But this is like an average over a decade, right? Yeah, and that's, you're pretty well aligned with me on that particular point. So geopolitical wise, like, okay, geopolitics is one thing, right? Like, if China and the U.S. got into like a hot conflict over Taiwan or something like that happened, or diplomatic relations like deteriorated to the point where we like don't have relations like that anymore and like don't have trade and stuff, yeah, both economies would crater. It would be horrible. It would be an absolute disaster, right? And if there was a hot war, like an actual hot war, like we're like opening fire, like worst case scenario, like our survival would be at stake. Like, who cares about how red our portfolio is at that point? But I think the real risk is the Communist Party, the government of China. So I view China and the U.S. as two sides of the same coin. The U.S. Businesses and corporations exert a lot of influence over the government, whereas in China, the government exerts a lot of influence over corporations. So in China, the risk is maybe that the government exerts some kind of influence to cause negative results for the business. That, to me, I think is the most realistic risk, but I don't think China wants to hurt their own businesses and their own prosperity. And I think also that they want Western capital to continue to invest in their economy and their growth. And they want to continue having, a trade surplus with us, etc. They benefit a lot from it, and they benefit a lot from our dollars. So until such time as there's not any benefit from their perspective for doing business with us, I think we won't have to worry about a lot of those risks that people are so worried about with this. Because China is a lot of things, but the one thing they are above anything else is smart and strategic. And, they can pivot really quickly in the short run if it means moving closer to their long-term objectives. So, all in all, like, I don't think you're in too bad of a spot with this. I happen to get lucky and get assigned, in like the $80-ish range, right? So, like, I just happened to see that there was like a really big disconnect between the price and what I thought it was really worth. And, it dropped further after I got assigned. I had to watch myself go into the red all the way down to like 58. I kept selling puts. I wish I would have gotten assigned more down at like $60, right? But I didn't. So you just have to be disciplined and know what you think the fair value is. And, if it's based on reasonable assumptions, that's really the best you can do if you're going to invest in individual companies, right? Yeah. And I honestly, hey, I'm in the boat there with you with, some Alibaba stock. So I'm hoping that we both turn out to be right in the long run and that it ends up being a great company that gives us really solid returns. But actually, that's about all I've got for tonight. I started a little later than I wanted, so I'm gonna hop off in just a couple minutes. But hey, if you had anything else, maybe something quick, something like 2-3 minutes, I could do it real quick. Also, are you in the Discord by chance? I definitely think you should hop in there if you're not already. There's some pretty smart people in there. Some of them have different takes on certain stocks, and it's always good to get a different perspective of somebody who doesn't think exactly the same as you. Yeah, definitely keeps you sharp. and forces you to kind of really think through the rationale for your own position. If somebody else gives you a counterpoint, you have to kind of, it makes you think more closely about why you're doing what you're doing. It should be in the description, actually. It'll make you wait a minute, or a few minutes rather. I don't think it'll let brand new accounts chat right away, and that's because we've had some people join it and start trying to imitate myself and sell courses to people and stuff, which anybody that actually watches me carefully knows that that's not something I would ever do to you guys. But there is a concern that maybe people who are newer could get tricked by scammers and that kind of thing. Unfortunately, any kind of investing based channel that has a Discord, some unsavory folks will try to take advantage of people trying to learn. And just know I'm not gonna DM you trying to teach you about the latest crypto scheme or anything like that. Not really my style. So, Well, welcome to the community, buddy. It was fun talking with you tonight. And I'll see you around. And for any dads listening, happy Father's Day weekend. I'll probably do another live tomorrow during the day, a little bit earlier for people. Other than that, take it easy, stay safe, and remember, price is what you pay, but value is what you get. Cheers.